the first video, I went through inflation, what's happening and how much prices are rising, and why the Bank of England, the Fed and the ECB all have a target for inflation of 2%. In this video, I'm going to go through the levers that the government and the treasuries and the central banks use to try and maintain and keep inflation at that 2% target. Hi, this is the third episode in the inflation saga. Sort of like the Forsyth saga, but maybe it's not quite as many episodes. First episode, I went through the 2%, the universal acceptance by all of the central banks, Bank of England, Fed, ECB, BOJ, Bank of Japan, and just about everybody else in the world, in the Western type economies, that's accepted this 2%. So that's the 2%. That's this year, next year, that's inflationity. It's 2% forever. That's what the central banks want. In the second episode, I went through the levers of control that the central banks and the government basically have. Government via the central bank, via the central bank, have to modify and change the inflation rate. And the inflation rate, which all of the countries tend to use, is the CPI. CPI has been modified. It's slightly different in different countries, but in essence, it's the consumer price index. In the United States, this has been changed a couple of times over the years, and each time it was lower after they did the change. They did the same in the UK. I think we've only changed it once or so, but we went from the RPI to the CPI, then CPI, and then we managed to get it down as well. down. The ECB people, they have a harmonized one for the Euro countries. I don't think that they have modified it yet, but if it gets too high, no doubt they will. So forgetting that the CPI is being modified, just let's assume that the CPI is robust enough. And in the UK, there's a discussion because housing and council tax, which is what basically like a property tax in the UK, isn't included in the CPI. There's another measure, CPIH, I think it's called, which is includes housing and the costs of maintaining having a house. The levers that I went through were tax, borrowing, interest rates, and our old favourite and my personal favourite, QE infinity. So in this one, I'm going to pull up a few graphs just in case you haven't got the memo that it's 2%. I'm going to go through a few graphs historically from around about 2000 to present time and show some of these things, show the inflation, show the interest rates, show the impact or the effect that they've had on each other. It's basically to try and show that inflation isn't going away. And if you have any assets, money, or intending to get them, then you need to take inflation into account with some of the things that you can do. That's for a future video. But for this one, it's just concentrating, just let's clear the decks with inflation and just finish this one off, because by now should realise there's very little that you can do to change it, unless obviously you're the head of the Bank of England or the head of the Fed. Unless you're working for one of these organisations, you ain't got any influence. You've got no control over it. You've just got to accept that it's here and it'll be here forever. There's two sides to the coin, obviously. The massive amount of debt, and could that massive amount of debt influence and possibly push some of the countries into higher inflation rates? Higher inflation, low interest rates, recipe for the old disasters. Doesn't have to be, but basically, if you're saving, you're wanting your interest rate to be above the inflation rate. Otherwise, you're losing purchasing power. Anyway, I'll hold these graphs up, walk through them, and show you the impact. All of these figures are from either the Bank of England, which is where I've got most of the stuff from, and some of them are from the Office for National Statistics, ONS. So I'll run through each of these in turn and show what the effects are and how the government tries to use these to keep the inflation rate on the 2% target. Roll VT, well, roll graph VT. This is a graph basically using data from the Bank of England. All I've done is taken their data, just bunged it on a spreadsheet and just graphed it out, basically so that I could get multiple lines, curves, histos on the same chart. What you're looking at here on the left-hand side is percentage. Percentage is both for the interest rate and for inflation. And on the right-hand side is the purchasing power. Right-hand side in the blue here, purchasing power. It's from 2000 to 2025, but obviously only got the numbers up to 2020. The base year is year 2000, and at that time I've based it at £1 value in the year 2000. The blue line is showing the purchasing power of the pound going down, and it's on target for 2025 to be at 50%, i.e. you've lost half your value. Present time, it's around about 60. It's went from £1 to 60p in 20 years. The lines here, the tram lines here, the 2%, that's the Chancellor's target, which he wants the Bank of England to maintain. He gives them some tram lines, give them a bit of buffer either side. 3%, 1%. If it goes above 3 or it falls below 1, that's inflation. Then he expects the bank to take some remedial action. The two sort of barrels he's got in his shotgun is interest rates and our old friend QE. The red line here in dotted is the interest rates. And obviously, because I'm only showing 1 year at a time, sometimes the interest rates change multiple times through the year. What I've done is I've shown the highest interest rate in any particular year. So you can't see the little steps, but it's near enough to give you an overview. Coming down, the dotted line is for the inflation coming down. From 2000 to 2008, I've shown it in green. Then obviously with the banking scam 2009, it's went negative. That's the reason why you've had this increase in your purchasing power, because inflation has went negative. You've had just a little drop of deflation. Because you get deflation, prices go down. Because the prices go down, CPI, Consumer Price Index, goes down, which means the purchasing power, your money gets reflated. Buys more. Inflation's above 3% here. So the banker puts the first cartridge in, blasts off some interest rate rises here, takes it up. And then it's overcome by events. 2008-9, you get the initial interest rates going up here. And 2008-9, you get the banking scam and you get the massive bailouts, massive public bailouts of private companies, private banks, basically, both in the US and the UK. There's immediate kick in, and interest rates not only are they lowered a little bit, but they're rock bottomed down to, at the time, what was considered virtually the absolute bottom, 0.5%-ish. And the interest rates were kept low, even though the inflation went above 3%. There was no, oh, it's above 3%, we need to do something. It was, we're in the mire, we've got these huge amounts of debts. We can keep interest rates low, we can reduce the public sector borrowing, interest payments. The low interest rates were extended, and gradually inflation came back within these tram lines, came within the target bands. Back 2017 or so, inflation was getting to the lower boundaries of these two tram lines. Interest rates started to get notched up just a little bit to try and get this inflation back up to 2%. It overshot here, and then the next year, 2019, was virtually bang on 2. Events happened, 2020 came along, and the interest rates were taken to even rockier bottoms. The small increases that had happened in the last couple of years there were taken back, and within a very short space of time, and I think the BOV had a meeting, and then virtually within the same week or so, they had another meeting, and they reduced it down to 0.1%. The likelihood of it coming away from 0.1% or wherever it is, to get inflation back, and this is a provisional figure which I had a look, and I think they were putting it in at circa 0.5, 0.6%, somewhere like that. If you follow, this inflation must be pushed back up to 2%, then you would expect interest rates to be pushed further lower. Because that's what you do if you want to push it up. You want to make it easier for people to borrow. On the right-hand side here, year 2000 started off as £1. And you should see a little circle come into view here. This is the pound's value, purchasing power wise, dropping. So it's reduced from, what's the text there? Purchasing power reduced by 40% from the year 2000. And if the the inflation rate continues at 2%, I've just graphed it through for that, it'll be down to 50%. Purchasing power will have been reduced by 50% by 2025 if inflation continues at 2%. Now these have been fairly low by historical standards, inflation rates, as you can see here, 3, 2, 2, 3, 3, 3, 3, 4, 4. What's the highest one? 4.5, 5, 3, 3, 3. And the money's reduced by 50%. If inflation rips and it gets juiced up, this number will fall, purchasing power wise, very quickly. So that's just a look back at the last 20 years or so. Purchasing power, interest rates, inflation, big crises, government borrowing. The next graph's got the government borrowing on, and you can see the borrowing has went up. The government wants to keep the interest rates down so it can manage its debt. If you've got a credit card or something like that, you could be paying anywhere from, I don't know, 15 up to 25% on your credit card. If the government had to pay anything like that, government would go bankrupt. It just wouldn't be able to finance its debt at those sort of levels. There's articles about which postulate at what percentage it would break. I don't know, 5%, 6%, 7%. Don't know. But at the present time, 0.1%. If it goes up to a normal rate for interest, as it was before the scam, say 5%, government would be paying 50 times more for its debt. It isn't, because obviously a lot of the bonds have got extended times on them. They're like 20 and 30-year bonds, and they were paying the interest on those. But for all the short-term debt that it's originating, we'd have to pay higher interest rates. It's a big problem. It's a huge problem for every one of the Western economies, because they're all following the same route. We've all went down. Instead of going to Kansas, they've all went to Tokyo. Bank of Japan started this caper off in the 1990s. And each step that the Bank of Japan has taken, people have poo-pooed it and said this is ludicrous at the time. And then click, 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 one by one, nearly all of the Western countries, US, UK, European countries, have followed virtually in lockstep. Time shifted, but followed in lockstep what the Bank of Japan has been doing. Lower the interest rates, keep on borrowing, start the QE, asset purchase, start that off, ratchet it up. It's not that it's a bad policy, it's just that we're not implementing it enough. We just need more of it. We just need to whip the slaves harder. It's not that whipping the slaves won't get the boat moving faster. We just need to whip them harder. If we whip them harder, the boat will go faster. This is what they're saying. We've now got the Bank of Japan owns a massive amount. Bank of Japan is like the biggest shareholders in loads of companies in Japan. They own the company virtually. They went past buying the debt. They actually buying the equity in the companies. It's the Fed's sort of half toying with it. It'll happen, possibly. Who knows? Conjecture. UK government buys gilts, i.e. its own debt, and it buys IG, investment grade bonds. It buys those because there's less chance of a default on the higher the grade bond, or at least you would hope so. So it's buying low risk bonds. It's not bothered about the yield on it. It just wants something that's not going to default, so it doesn't lose the whole thing, because it's got to put it on its balance sheet. But it wouldn't make any difference even if it lost money. There'd be some jiggery pokery that the Bank of England would carry out to wash it away, I'm sure. I'm just being cynical. Don't know enough about that. So when and if it happens, we'll find out. We'll find out the chicanery. But it'll all be covered up. Don't worry about that. Nobody will get fired. That's me getting off topic here. There's another graph, like I say, coming up with showing the debt. I don't know. It's you see the numbers. It's just incredible. What's the reasons for it? Some people say this, some people say that. But obviously, at some point, somebody should have said, stop. This nonsense is getting out of hand. Where they need to cut back. They tried that with the austerity. Nobody likes that. Didn't want austerity. Nobody wants that. Raise taxes. Nah. Nobody wants any more raising of the taxes. So, yeah, in the situation of borrowing, you cannot afford the rates to borrow. So in unison with all the other central banks in the world, you've managed to get the rates down. If they make a surge, if there's a surge back up for interest rates, if the government can't sell its bonds, and remember, someone's got to buy them. The government can't sell its bonds. It's got two options. It either QEs its way out, or it puts the interest rate on its bonds up. which starts to make it untenable. Because if it say it's got to put it up to 5% instead of 0.1%, it's 50 times. So where the government can borrow £50 now to pay that amount of money, would only be able to borrow £1. Huge difference. I'm not suggesting that it'll go to 5%. I don't know. I'm just no AP with a Mac prattling about, looking at shit and drawing a few funny coloured graphs. You know, I don't know. But you've got, you cannot take this serious, can you? If you took it serious, like, you know, it would drive you bananas and stuff like that. But it's serious stuff. All of this stuff affects people's lives, affects their savings, affects their jobs, affects their standard of living. Sure as shit is shit. The rich will get richer and the poor will just get not rich. Anyway, let's roll on and see what the next graph brings. Okay, this is just an interlude on what billions are basically. Most people, myself included, you're not used with dealing with billions, but in the government finances, this seems to be the most common term. Obviously, if things keep going the way they are, it'll end up being trillions. Just a short run through. Obviously, thousands, which is 10 to the 3. 10 to the 6 is a million. So if you go 10 to the 9, that's 1 with 9 zeros behind it. That's a billion. This is the financial franca at the moment in all of their stuff. What I've done is I've tried to relate this back to a person. UK, the population 68 million. So if you take 1 billion divided by 68 million, all you have to do, obviously, is knock the 6 zeros off. It's the equivalent of having 1,000 divided by 68. 1,000 by 68. 1,000 by 100 would give you 10. 68's 2/3 of 100, so it's £15. When any government report says they're going to spend 10 billion, then they're going to need to get taxes equivalent to 10 times £15 off each person in the UK. The national debt, it's went past the trillion stage. So it's went past 999 billion, 999,999,999, and it's clicked into a trillion. This is a trillion, it's 10 to the 12. £2,500,000,000. Same caper. Knock 6 zeros off, leaves you with 2,500,000 divided by 68 because you've taken the million out. Gives you 36k, £36,000 per person. Family of 4, or a family of 2 would be 72. family of 440 or 150k pounds. At the present time, the national debt's going up approximately £6 per person per day, every day. If you jump across the pond, go to the States, their population is about 332 million. It's approximately 5x what the UK's is. So you would expect to divide £15 by 5 for 1 billion. This time, obviously, the billion's in dollars. So it's $3. So for an American person, every time they hear billion, they just think, well, that's $3. That's $3 that they have to put into the pot for taxes. Approximately, average, median, you know. So the stimulus that was going on recently, we were talking about circa 900 billion. So 900 times 3, let's give you $2,700. That's $2,700 per person to come up with 900 billion. The US is on roller skates with their national debt, and they're now into 2 digits of trillions. They've got it up to 28 trillion. And at the rate they're doing the debt, it's going up $12 a day per person in the US. So you can see this 28 trillion ain't going to be at 28 trillion for long. UK debt's 2.5 trillion. US debt, 28 trillion. You can go back and find why they're called millions and billions and trillions and stuff like that. And it's all to do with Mila and stuff like that. Just like when I worked down in Sicily for a while. Filled the car with petrol. This was when they used liras. Piano, fill the car up. 50,000 lira. What? 50,000 lira to fill my car up with petrol. It's only a little Peugeot 205. Nice car. 50,000. But it's just the numbers. It was about 2,000 lira to the pound at the time. So all you do is knock the thousands off 50 divided by 2, 25 notes, 25 pounds. And it's the same with these billions they throw you. So the 2 numbers to remember are every time you hear a billion in government speak, they're talking about £15 on average that you're going to have to put in. In the States, they're talking about $1 billion, it's $3. Just a little clarification, because what I've tried to do with the graphs is put them back to per person rather than billions. Most people haven't got a Scoobies when you're talking about billions and trillions. Most people will not be able to tell you what a trillion is. That's it. This is a table which I pulled some data off the BOE and the ONS. It's basically from 2012 through to end of 2020. The end of 2020, the figures are still provisional, but these were the best ones that I think I could pull off. The table is the year's national debt in billions, which is 1,000 million. When I was a kid, a billion in the UK used to be a million, but it's not anymore. It's been devalued. It's just 1,000 million now. The UK population, as you can see, it started there in its started here at 2012, 63 million, and it's circa 68 million 2020-ish. So you can see there's been a gradual incline, basically 5 million people added. It's about a 6 or 7% increase since 2012, that's in 8 years. Obviously this affects a lot of things, housing, multitude of things. But what it does do is that it means that there's more people to share the national debt. So the national debt per person, because I think that's maybe an easier way for people to look at it, in 2012, it's 22k. And as you can see, it's clicked its way up, and it's over 30k now. That's with the increase in the population of 5 million people. So obviously the national debt has been going up faster than the national population. This figure comes from Maastricht. It was done in the 90s. It was for the more unification of Europe and to get the common currency, to get the ability for people to work all over Europe and all the rest of the stuff. And they came up with a heap of little tick boxes, and this is supposed to be the national debt, supposed to be less than 60% of the GDP. Well, these are the percentages here. That was in 2012 when UK was still part of the EU. Nobody takes any notice of it. I mean, to say if Greece can get into the euro, what is these 60% and stuff like that? I mean, it's just, they could have picked any number, it wouldn't have made any difference. Anyway, the national debt at the moment, as a percentage announced on the radio and that, was 99.5. So we're just getting ready just to step into 100 plus, the ton-up club. We're part of the ton-up club like Japan and some of the other countries. The interest rates, this was the highest interest rate in the year, 0.5, and for 2012. And there was this little blip up here for 2018 and 19, when it looked like interest rates were starting to migrate upwards again. But in 2020, with the event that happened then, it's at 0.1. This is a mythical made-up number, and it's not correct, obviously. But what I did was I said, what would be the cost of the national debt if you were paying for it at the bank rate per head of population? Now, it doesn't work like that, because obviously some of the bonds are higher paying bonds, which are still ongoing. The government has to service those. And then obviously it's pumping out longer bonds in the future, and the interest rates are higher than the bank rate. But all this was just as an indicator. And you can see that it goes up and it fluctuates with the population, with the bank rate, and with the national debt. So you've got the population, you've got the national debt, and you've got the interest rate. Those three factors are giving you these figures here. So you can see it goes up as you would expect as the interest rate goes up. And then here, presto, even though the population's going up, so it's helping to reduce it, the interest rate's up, so that's went up. But here, presto, even though we've got a mega population, we've got massive national debt per person, because the interest rate has been rock bottomed down to 0.1%. It would only cost you £31. Now these numbers are not correct. Just saying, just giving you an indication. If you could have all your debt paid at the national debt, I'm just showing you what a huge effect the interest rate has on your payments. This is the QE, quantitative easing, rebar, reverse bond for the asset rich. This is in billions again. This is thousands of millions. 375. They come up with a number and they buy stuff up to that number. And when they get to that number, they just increase it. Over the last 10 years, that's what's been happening. It's sort of like you hear these budget things in America and the waltz around and they wait to the last minute and people are saying this, that and the other, and they just sign it off. Yep, we'll increase the signing. Yep. Everybody knew it was going to happen. And it'll happen all of the time. Nobody wants to step in and do anything about it. And it went up to 4.45 billions, that is. And now it's at 895, huge increase. Obviously, the bulk of the increase you can put down to the event in 2020. This is the QE per person, £5,800. That's per head, per person. So little kids, little babies, old age pensioners, everybody. So you can see how the QE is now at 13,000 per head. This is the QE as a percentage of the national debt. 26%, and we've managed to end up with 43%. But you can see it's hovered around the 25%. But obviously, with what's happened in the last year or so in 2020, this has been kicked up. So this is the national debt plus QE on a per person basis. Let me clear this. On a per person basis. So it was chuntering along in the high £20,000 per person. And it's migrated its way up, and we've now managed to get it to 44k per person for everybody in the UK. That's a combination of the debt, national debt, and the national QE. would be 44,000. So it's this figure here plus this figure here. Add them together. That's what you get. So the national debt and the QE is a percentage of the GDP. 126. Same again, fairly static. And now it's 143. Same reason. You've expanded the national debt on a gigantic scale. So this is the UK national debt per person, and the debt is a percentage of the GDP. It's just the table just graphed out, just sometimes easier to look at. This tends to, if you're observant here, this tends to go slightly down. And the reason for that is because the population is going up faster. So the per capita amount is going slightly down. But you can see here's the Maastricht 60%. And the UK was in the EU all this time. It was way above. But don't worry, the rest of the countries in the EU are just as bad or good or whatever as you want to look at. So here's the national debt in green. And here's the QE in the sort of tanny colour. So you can see as a percentage of the national debt, QE has went up quite a lot. It's easier to do the QE than it is to do the national debt. The QE, you just magic the money up and you buy bonds with it. The national debt, you've got to get somebody to buy this for existing cash. You can see, even though the national debt's leaping up, the QE is leaping out. It's just leaping up faster. So this red line here, this is debt, is a percentage of GDP. Down. Oh, doesn't want to do it there. Okay. So at the moment, we're just under, we're 99.5%. So there's the Maastricht. We don't need to hold to it anymore because the UK is out of the EU. So you can see just gradually ticking along within a band, and then it's shooting up. There's two things. As if this continues to go up, if the debt continues to go up, if the QE continues to go up. The problem that you have as well is the tax base that you're trying to get the money from. At the moment, the government's been pumping money into the tax base with all of the schemes to assist people to bail stuff out, if you want to use that term, or to assist people that have had to not work through no fault of their own, but through what's been going on. If this tax base goes down, i.e. more people unemployed, that's money that the government's got to pay in unemployment. It's also a loss of revenue in taxes. If that person was working and now they're not, the government is possibly paying unemployment benefit, maybe some other benefits, and it's lost some tax revenue. Also, if a person is out of work, their amount of income goes down. They tend to consume less. If they consume less, they pay less VAT. So you're not getting any PAYE off them, or NIC, because they're not working. These numbers are sustainable, if you want to use that term, manageable, on the basis if you've got an expanding economy. Problem comes if you've got a contracting economy. It accentuates all of the deficiencies that you've got. You've got a high GDP ratio. Talk to different people say different numbers are good or bad. But it puts you in a difficult position. You've got lots of debt. You're on a world market for debt. The US has got debt. The Euro countries, debt. Japan, debt. Blah, 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 blah. All of these countries are competing for the money. Although there's a huge appetite for debt and it's used widely, if every one of these countries steps up the amount of debt like they have done, there's a tendency for whoever's last to lose out, because money would just flow. Like, say, in the UK, money would flow to the US if you can get a better rate, or it would flow to the EU if you can get a better rate. What that then does is it means that the UK has either got to double down on the QE and buy more of its own debt, or it's got to put the rate that it pays on a bond up. If it puts the rate up, then the interest payments, the coupon, the yield, dividend, the amount that you're paying each 6 months on the government debt has to go up. You've pushed the rates to zero, or as near zero as you can get. It's obvious, and it'll be obvious to the government, it'll be obvious to the Treasury, and it'll be obvious to the Bank of England, it'll be obvious to anybody else that looks at it. If anybody breaks ranks for whatever reason on this, then it could be pandemonium. What's happened from the banking scam, financial crisis, global financial crisis, is they kept interest rates low all the way across here, low, low, low. Gradually, the economy has sort of recovered bit by bit. It's been assisted by QE for the liquidity into the market. The national debt has went up slightly. Percentage-wise of GDP, it hasn't really affected. So your debt to GDP ratio has remained reasonable in this sort of band here. It's remained reasonable. Now it's spiking up here. Hopefully, people will get back to work. The economy will start to recover. But it depends on the rates. The government needs to keep the rates low. Otherwise, it'll have a real difficult, not just the UK government, the US government's the same, the Euro governments are all the same. Wouldn't it have been really different though if your GDP to debt ratio had have been down here? You would have had room to manoeuvre, or more room to manoeuvre. I'll stop this here. There's still a little bit more of this graph to go, but I'm getting phone calls from Trotsky saying, Leon Trotsky, the guy that wrote War and Peace, saying, you need to package it a bit smaller. I think that should be Tolstoy. I think I've been listening to the Jam too many times with Trotsky. I don't know. Did you write any books? There's still got a little bit to go, and there's also a bit of an addition which I've added on, and there's also another chart to go through, basically showing where the tax is spent. So I'll close that one off, but I'll continue this on the next video. Okay.